shift focus then to earnings season. A weak first quarter coming in for escorts this quarter. The company's profits plunged by about 28%. Margins also saw contraction in the quarter gone by, coming in at that below 10% mark, so 9.8% versus a comparable figure of about 12.2%. This, of course, on a year-on-year basis. Now, apart from that, in addition to the kind of slowdown that we're seeing in the auto space, the drop in construction activity has also impacted the top line for escorts. To help us understand all that went on in the quarter gone by, Bharat Madan, Group Financial Controller of Escorts, is joining in. Welcome to the show, Mr. Madan. Good to have you on. Definitely, you know, we're seeing this pain play out, and it's not just your company, it's across the board. Sales looking fairly weak as far as the first quarter goes. Can we expect things to get better as far as the second quarter goes? How have things been so far?
Yeah, I think first quarter really thing went, I think it's just below expectation, and we also were expecting initially that first quarter actually should some sort of growth, but the way the industry has behaved because of various reasons, obviously. So because of the poor monsoon, the delayed sowing and low sowing than last year, low the water reservoir level, and withdrawal of subsidy from the government side, which was there in the last year. And there are several factor activities played out, which are negative in the first quarter. So though we expect, I think, for second quarter, which will be seeing the beginning of the festive season from September, we see some recovery happening. So may not be similar degrowth would be seen in first quarter, but still I think the degrowth may continue for some time. So we are still banking on the festive season to really see some revival happening, and depending on how the monsoon the distribution happens and how much we will end up with the shortfall, we should actually see some revival there, and that should neutralize some of the downside which we've seen in the first half of this year. Or on a full year basis.
All right. I want to ask you about the slowdown that we're seeing in construction activity and capex also, because this is a big concern even from a macro point of view for the economy. To what would you attribute this kind of slowdown that we're seeing at the moment? How much of this is being aggravated by, of course, the liquidity crunch that customers are facing, and how much of it is something else, cyclical, systemic slowdown?
I would say it's more attributed to the liquidity issues, I think, in the market, because we have seen good order traction is there in the market. The demand is there. The order book is actually flowing in, but obviously liquidity is a concern. We're not getting the expected financing, especially on the off-road side, on the construction equipment vehicle side. So probably once the liquidity position improves, then we see the financing getting revived. And also after the budget approval now, we expect the government will start allocating the money to various ministries, and the spending probably from government side will also get revived. So we'll see probably a recovery happening in the second half in the construction equipment segment too.
All right, your railway division has actually done fairly well in an otherwise tough quarter. What has improved? What do you attribute the improvement that we've seen on the margin front? And also, if you give us a sense of the order book at the moment for railway equipment, what is the kind of execution timeline that you are looking at?
So then we had guided for roughly 15-20% growth, which we think really will get delivered. So we expect I think 20% growth is possible in railway segment, which is what we have seen in the first quarter also. And we had a very good order book when we started the year with about almost 490 crores. And so the current order book has slightly gone down to about 400 crores because of the elections and the budget getting approved now. I think again, it's the same story as in construction. I think once you got allocation of budgets to the railway ministry, a lot of tendering has happened, so the order book really will start flowing in now from September onwards. So fully basis, we selected the division to do better, and it will still deliver about 20% growth for last year.
All right. In terms of the margin, then what can we expect for the railway segment?
So railway, so this quarter we've seen good margin because the mix was really good compared to the last quarter, sequential quarter. Though I think the very last year it was lower. On a full year basis, we expect I think that the margin profile will still be in the range of 17-18% because we are seeing the increase in the portfolio of new products which are getting introduced, where still the import content is high. So the margin is slightly lower there, but the order book flow will be pretty good after that.
All right. What would be the plan on the capex front? Would you be undertaking any capex at this point?
Yeah, so capex is actually ongoing even in the tractor division. So, for example, we are expanding capacity now. So, last year we had started that phase and a lot of products are already in place. So, this year we expect the capacity expansion will get completed. So, we should be sitting at a capacity of roughly 120,000 on an organic basis, other than the JV which we have done with Kubota Corporation, where another 50,000 capacity is being set up, which will be up and running from June of next year. So overall, I think Escorts will be at a capacity position of roughly 100 50,000 tractors by June of next year.
All right, Mr. Madan, thanks very much for joining in, helping us really understand what's leading to the kind of pain in the sector at this point in time. It is, of course, the slowdown that we're seeing on the auto side globally at this point, and also a slowdown in construction activity and execution. Definitely seeing that weakness play out for Escorts numbers, and it's a view coming in from the management as well. But on that note, we'll wrap it up on this edition of Trending Today. Thank you so much for watching.